Welcome to Stony Finance Lab channel.
Hi, my name is Hamza Miran.
Hi, I'm Rachel Gurevich.
Hi, my name is Arush.
In our presentation, we will be explaining the necessary steps for purchasing your first home in the most efficient way possible. Here we have listed some keywords that you should be aware of before we begin. Investment assets are items that are obtained for producing additional income or held for speculation in anticipation of a future increase in value. Examples are mutual funds, stocks, bonds, real estate, and retirement savings accounts. Long-term investing is a passive investment strategy, which means that your assets are held for over a year. This is done in search of a steady growth for those who do not have time to be actively exchanging. A loan is a borrowed sum of money or an item of property that is expected to be paid back with interest. When purchasing a home, this interest will be paid back in the form of a mortgage. The cost of a mortgage will depend on the type of loan, the amount of time, and the interest rate that the lender charges. Credit is an agreement between a lender and a borrower that refers to an individual's trustworthiness when borrowing money. Borrowers will receive a credit score that indicates to lenders their capacity to repay a loan. When something is bought on credit, a down payment is the initial payment made. It is important to have the highest possible down payment because taking out a smaller loan could make getting approved easier. Also, your monthly payments will be lower as well as a lower interest rate. The target audience for our presentation is graduate students. This is because they're at the optimal age to begin their process of investing. Most graduate students will have a job that provides them with steady income and growing income. Therefore, they can begin investing while still being able to support themselves in life. Most graduate students do not have children, and many still live in their parents' homes, which allows them some time to invest and save their money. Many also have established savings accounts, which makes them more likely to be financially literate. Since they've had experiences with savings, they will be able to understand the importance of investing. The purpose of our presentation is to help graduate students achieve the following key goals. The ultimate goal of the entire process is to eventually own your biggest financial asset to date, which is a home. Ideally, this goal will be achieved when you're in your early 30s as you've settled into your career and can begin to build a family. Ideally, we want you to maintain a steady income throughout the entire process, which is why we must be careful and smart about the investment strategy used. Now, the goal that we hope to achieve within the process of attaining this asset are the following. We want you to be able to put down a large cash down payment on your loan. This will save you money in the long run. We want you to be able to have the lowest possible interest rate on your mortgage. This is achieved through having a large down payment and having a good credit score. We want you to stay financially secure throughout this entire process, and this will be possible through our safe approach. Eventually, you'll be able to pay off your mortgage and live in financial freedom before or around retirement.
In this slide, I'll be talking about the vehicles and resources we recommend to achieve the American dream. First is Vanguard. In our strategic plan, we would like to use Vanguard mutual funds and ETF. Vanguard is a large investment firm with over 7 trillion assets. Our plan is to invest much of the money you would leave in a savings account, which with these two resources offered. A traditional savings account on average only gives 0.06% of interest, a long way off our goal for a hefty down payment. Second is credit is our number one best friend when we try to obtain financial assets or goods. Credit score is a necessary tool that we should use in our arsenal, as credit in our strategy allows us to obtain a low interest loan, a broader scope of financial institutions offering us loans, and a great credit score is the second best thing after cash. Loans. Our third step in achieving our goal is obtaining a loan. Most people don't have enough to pay off a house in one go. This is where we use our cash for a down payment as well as our amazing credit score to achieve our goals. These two options offered are conventional and an FHA loan, which both offer pros and cons to each one. And lastly will be first-time homebuyer offers and state and county incentives. Vanguard's Total Stock Market ETF. An ETF or exchange traded fund is a shared option of securities, ETFs, which can be bought like a stock, which follow a particular index, sector, or asset. Example would be like technology or the automotive industry. The Vanguard Total Stock ETF tracks the performance of the CRSP US Total Market Index. This ETF has no minimum investment. The ETF as well uses much of the fund on big tech companies, as we don't want the ETF doesn't have much of fees. The fund has an exposure rate expensive ratio of 0.03%, which Vanguard receives for conversation. This is a charge on all assets of the fund. This fund is a blended risk, meaning that it isn't a short-term or long-term fund. As our use is very not risky, but also not on the conservative side. We want our money to grow, as we don't want the profit to be used for a cash down payment. We have offered a link below to learn more and set up an account as well. Next resource is the Vanguard Life Strategy Income Fund. This is a diversified low-cost fund. This is a conservative and tries to provide current income some appreciation. Like I said before, we do not want to be aggressive and very risky with our potential down payment. This fund has a minimum investment of $3,000, a relatively decent investment, but one that offers a steady growth potential. A low-risk mutual fund which offers a quarterly dividend, and the link provided below shows an overview and a setup guide as well. In a hypothetical situation on the graph shown on the right, a potential investment of $10,000 within 10 years would have grown to $15,000. Obviously, we do not want to have that. We want to add to these funds and contribute to it to have money grow and appreciate.
Credit is another important part of this process, and it's necessary to maintain a very good credit score if we want to achieve our goals. You may ask, what exactly is a credit score made up of? Repayment history accounts for 35% of your credit score. Your repayment history is an indication of how safe you are to be loaned money. New credit applications account for 10% of your credit score. To keep your score up, you should avoid applying for new credit cards or loans. Other factors that will affect your score include your current unpaid debt, the number of loan accounts you have, how much of your available credit you're using, and if you've had debt sent to collection, a foreclosure, or a bankruptcy. You may also wonder, what is a good credit score and why is it important? Good credit improves your chances of being approved for a loan, and it will also allow you to borrow money at a lower interest rate. A very good score is anything 740 and above. This is the ideal score that we want you to maintain. In order to maintain this high score, be sure to pay all your bills on time. You should be using your credit card for convenience, not for carrying debt. You should never just pay the minimum on your cards, because this is not a good way to pay off debts. You can consider a balance transfer card to consolidate all your monthly payments onto one card. You should always be conscious of what you buy on credit. Avoid buying anything that loses value over time. If your credit score is not the best, there are measures that you can take to boost your score. First, you can talk to your creditors. If you begin to face financial troubles that could affect your ability to pay your bills, you should call your creditors right away to arrange alternative payment solutions, negotiate a lower interest rate, or otherwise mitigate the situation. Another way you can boost your score is through credit boosting services. One company is called Self, which allows individuals to take out a loan and pay it off each month. When you make a payment, they'll report it to the credit bureaus, and your credit score and profile will likely improve. Another is Experian Boost, which allows you to include payments to your credit score which otherwise would not affect your score, such as positive payment history for utility bills and cell phone bill payments. These services are free.
Next, we'll be talking about the loans and programs. First up, conventional loan. The conventional loan is the most common and most distributed by the banks. We use the loans to offset the remaining balance of our mortgage. These loans usually require about 15 to 20% down payment. And within the New York tri-state area, which is about a house would cost about $600,000, a down payment would be around $30,000. This type is the most stable and options of the loans. No need for mortgage insurance, as well as less hassle and paperwork in obtaining, as well as giving us a higher loan limit as well. However, it requires a higher down payment, higher credit score to obtain. The next is the FHA loan, which is a resource for people with low to modest income. These are government-backed loans and offer lower credit threshold, scores to qualify, and a lower down payment of around 3.5%. However, mortgage insurance is required for obtaining this. A mortgage insurance is a policy that insures for the lender, a monthly expense added to the mortgage, also collected for 11 years or until the end of the loan. FHA loans are only used for primary residence. However, the ability to refinance is the best option, as you can turn a FHA loan conventional loan. This also allows for a lower down payment and more money to invest and grow.
Right, so now we'll discuss the mistakes we should avoid while on a guide to buying or purchasing a home. First of all, we should always prefer mortgage payments over rent, so that you can put your hard-earned money towards mortgage payments, and then after the end of the term, you can have an asset in your name, which would have also increased in value. However, if you pay rent, then you're just giving the money to your landlord for a service, and you would not gain anything at the end of your term. You should always use a credit card only for convenience and not to carry a balance over, as credit card companies could charge you as high as 24% APR. You should also consider living a lifestyle where you do not have a high credit card debt. But if you need urgent money, you could always use the introductory offers of these credit card companies, which offer interest-free loan for like 18 to 24 months. And third, you should never delay investing. You should not keep your unused cash in your bank, as it will use the power due to inflation. You should start investing today, and you should start small or whatever you have, but do not keep it in the bank, or it will lose your power. Investing comes with its risk and return. So investing in your money, invest as a passive investor who is working a full-time job, it is always advised to invest in the bottom two tiers of this pyramid, so that you can continue with your work as well as gain some money on the side without being exposed to too much risk. The base level of investing, which is the least risky and which provides the least return among the three, is government bonds, money market instruments, certificates of deposits, or just keeping your cash in the bank. The middle tier, which is moderate risk and gives a moderate return, is like real estate, mutual funds, stocks, high income bonds, large and small capital stocks. The third and the highest risky and the highest rewarding is the options, futures, and collectibles. These type of asset classes require a lot of knowledge and training and a lot of time too. So these are not advised for a person who is a passive investor.
Here's just a quick overview and summary of our plan. Invest, obtain and use a good credit score, acquire low interest loan, and hopefully obtain your first home. Thank you so much.
Thank you for watching this video. Please feel free to like, comment, and subscribe to this YouTube channel.